Good afternoon. Great to see everyone, and thanks for investing time in our business. We're delighted to be up in front of you. Before I start, actually, I'd like to invoke a bit of Shlomo love here and acknowledge that in our presence is someone who was voted number 2 IR professional in our sector with his team by the II rankings just last week. So I think that's terrific. I think in our sector of brokers, exchanges, and asset managers, of which number 60. Noah and his team were acknowledged as number 2 overall. So not without a lot of work and striving to be really good at what they do. So congrats to the team. I think it's great. So why are we here? Actually, more importantly, why are you here? It's the platform strategy and the origination strategy is something which has garnered quite a lot of focus as we've traveled around in the last year or so. And we've been publishing more information because it's so important to what we do. But it's something that really, it was the Credit Suisse Atlas transaction that catalyzed the interest. It really sort of brought home more of what the strategy is. And so we've heard feedback from many of you and others that people want more information. So that's why we're here. And so you've heard from Chris on the strategy. You've heard from 3 of the platforms, which are really interesting case studies. They're each scaled, and they're each different from each other. And so what I'll do today is connect the strategy to the financials. And I think what I hope you'll find from today, from what you've heard and from what you'll hear from me, is we are able to produce a recurring supply of investment-grade quality assets. We have the infrastructure to do that. I do think we have a competitive advantage based on what we've built. Our credit loss experience is de minimis, and we focus a lot of time on managing credit risk, as you've heard from each of the case studies. We have a highly capital efficient model, which I'll delve into. And all of this brings with it earnings benefits in the form of both fee earnings for the asset manager and spread earnings for the retirement services business. So It's been 2 years, actually, almost to the day since we did our Investor Day in the fall of 21. It's been a little under 2 years since the merger between Apollo and Athene was consummated. And so I think at the time we had laid out the thesis for the merger in 4 steps, which are here, and I'll address them. I do think, though, it's important that the benefits of the merger today, I think, are better understood and greater than we thought they'd be back then. And I actually think from all of our travels and meeting with different constituents externally, I think that's also acknowledged externally. And so in some cases, I think the benefits are meaningfully greater. So 4 benefits, we'll cover 2 of them, and we are covering 2 of them in more detail. But firstly, alignment. What does alignment mean? We talk about alignment a lot. Alignment is a couple of things. Actually, it's alignment between the asset manager and the retirement services business in developing products and transactions and coming to market. It's also alignment between the firm, the package of that group, and our LPs. And there's multiple points of cooperation and co-participation in financially in transactions that demonstrate that. In cross-platform, and I think this is where we've seen more benefit than we expected. If we go back to the 3 initiatives that we laid out at the time of the Investor Day, of which Originations is one, and then if we think about the other 6 or so that we've unveiled since then, including more recently Atlas and our asset-backed financing strategy, most of them at least require cooperation between both sides of the house. Some of them are dependent on that cooperation. And so I think it's really, really important to acknowledge that the merger brought about a lot of the growth that we're focused on now, which is almost exclusively organic, is a function of the merger. Importantly, we believe that owning production is critical. It's a competitive advantage, and you have to be able to create differentiated production of credit. And then we have lots of capital flexibility. We are highly capital efficient, and that's partly driven by Athene's alternatives portfolio, which has since become AAA, which is being marketed to outside LPs. It's partly a function of Athene's investment-grade balance sheet, which takes senior risk. It's partly a function of the equity sidecars that Athene has in the form of the ADIP family. And it's also partly in the form of syndicate capital that comes into us through our capital solutions business. So plenty of ways for us to access capital around the system. I didn't mention holdco capital, and so we have very, very few uses for holdco capital, which I think is really important. So why are we focused on origination? In our opinion, the public markets offer little alpha today. It's hard to find. Providing alpha to clients is what we need to do. It's fundamental to our purpose. And so if we can do that, it's pretty simple. We can create benefits in earnings to shareholders in both fee-related earnings terms and spread-related earnings terms. And I'll go into the multiple forms of those earnings in a minute. So as we originate, and you'll see it's different for each of the platforms. There's not a formula that is consistent across the board given the construction of platforms and the production and the capitalization of each of the platforms. But in simple terms, we allocate across three capital pockets. We allocate to our retirement services balance sheets, principally Athene, also Athora. We allocate to our third-party funds and what we call SMAs, or separately managed accounts, which are really just funds of one. Large institutional investor comes in. And then lastly, we allocate to the market, if you like, through our capital solutions business. Credit, mostly investment grade, some below investment grade, is syndicated through this business to the market. What we are finding is we want repeat business. We want LPs to come into our funds, or we want participants in our capital solutions business to know us and to come back for repeat transactions, which they're doing. We're also finding crossover between the two. LPs become participants in our syndication business and vice versa. So Chris earlier talked about the 25% of everything, and it's been touched on a few times. What actually does that mean? Mathematically, it's something like this, and it's not a formula. We don't hold to this strictly, but we want something like 25% of the high-grade origination, created origination coming off platforms to go to our retirement services balance sheets. Think Athene's investment-grade fixed income portfolio. We want something like 50% to go to our third-party funds and SMAs. And we want the last 25% thereabouts to go into the market to our syndicate capital partners through our what we call our capital solutions business. Really importantly, I think, for each of these three shoots, if you like, we share the same assets at the same time, at the same price, on the same terms. So everyone is getting equal economics on product that goes into each of these channels, and making sure that each of the capital pockets derives that equivalent benefit is really important. So how does this pull through into earnings? It's really at least in two ways in each of our asset manager business, fee-related earnings, and our retirement services business, spread-related earnings. So when assets are allocated into funds or separately managed accounts, we earn management fees. That's one of the key reasons our credit business management fees have grown by 16% over the last 2 years. For the piece that goes through our syndication process, we earn a fee up front, no management fee, upfront fee. That business, some of you will recall, we had indicated that business should get to $500 billion of annual revenues by 2026. We said that 2 years ago at our Investor Day. We're at that level today, so 2 years into our 5-year plan. So that business, partly benefiting from this whole strategy, has really hit stride and met its plan. And then and Chris touched on some of this earlier, on the Athene's proxy for retirement services side, the equity that's deployed through AAA, which is its alternatives portfolio, earns a return, mostly a cash-on-cash return in the case of these platforms, which is, we say low to mid double-digit ROEs. And that creates alternatives income, which comes through Athene's earnings into SRE. And then the investment-grade credit, often in tranched, structured form, that goes onto the senior part of Athene's balance sheet, which brings with it 100 to 200 basis points of excess return, then comes through spread earnings as net yield. And so both of those last two reasons are key to, but the benefit we've seen in Athene's earnings, where it's grown by 30% annually for each of the last 2 years, is driven by the excess spread that we can create and higher rates, which are also favorable for the business. So if we look at an example of a scale platform, and again, you can see just from the three we've highlighted today, no platform is equal in terms of capitalization and production. But on average, if we were to invest $1 billion in a platform, if we average this across our ecosystem, we would create about $6 billion of annual flow of credit. And so economically, I think the easiest way to look at this chart is horizontally. If you focus on the top part of the page, that $1 billion of equity derives a management fee that we earn as a result of it being owned by AAA. So we charge a management fee on that equity piece. And then we've modeled, in the case of these platforms, a 14% return, and so return on equity, and so that comes through the spread earnings business of Athene. So that's the equity piece. It's a management fee and it's spread earnings at a low to mid teens return, low double digit to teens return. And then on the debt side, we've assumed illustratively the same split. We've assumed of $100 of investment grade credit, or of the $6 billion in this example, 25% goes to the market through capital solutions, 50% goes into funds and accounts and earns a management fee, and the last 25% goes onto the investment grade piece of Athene's balance sheet. And I won't go through all the assumptions. The math is on the table to show how that pulls through. I think one important point I make is that the top right box, the 14% return on the equity, in and of itself is an attractive return to AAA and to the third-party investors that come into AAA. So each of the other earnings streams here are incremental to that and accrued to Apollo, to AGM. So if we dig in with a little bit more of an FRE focus, I think the left side here is pretty well understood. 16% growth rate in yield, which is credit management fees over the last 2 years. This will be the key driver of management fee growth from here on out. I think the right side is interesting. If we look at the mix of business in our capital solutions business, and I want to transition from one to another in a moment, if we go back a couple of years, the mix was closer to 50% equity and debt. We're now run rating at close to 80% debt, 20% equity, meaning if you look at the fees that are derived from this business, 80% of the fees come from debt business and 20% come from equity business. And so that's important because credit or debt origination is more recurring, more predictable, more durable. And so that's what we're very focused on, building out the predictability of this earning stream. So we're also very focused, as many of you know, on growing third-party AUM. And that is also partly fueled by the origination strategy. And so if we look at the AUM in our third-party credit business, which really represents this strategy, and for this purpose we included ADIP because it's backed by third-party capital, or the assets under ADIP. We've seen a 4x increase in assets in the last 7 years. We've seen a 2x increase in the last 4 years. And this is a trajectory that we would expect to keep going. Again, origination is critical to this growth rate. And I think it's important that origination benefits a variety of strategies in our credit business, including, much more recently, our asset-backed finance business. If we then look at Athene's balance sheet, and for this purpose, to be consistent with the prior page, I took the ADIP assets out, and you look at what the sort of the net Athene balance sheet is, net of the ADIP equity participation. About 45% of Athene's balance sheet today is represented by assets that have been originated by the asset manager, by Apollo. And that really comes in two key buckets. One is all the assets that come through the origination platforms, the 16 platforms. And the second piece is other assets that we originate in our credit business, corporate lending, CLO formation, high-grade alpha, and so on, all the businesses that we talk about. But the two combined bring the created product in Athene's balance sheet to about 45%. The other 55% is CUSIPs, liquid, sellable. That's for liquidity management purposes. So I think what's important here is that the outsized earnings that we've been able to create really come from this: investment grade, senior, less liquid, excess spread, and risk appropriate assets for a regulated insurance company balance sheet. And it's the same type of product that Athene's competitors want. And so we often syndicate through to Athene's competitors through our syndicate business because they want the same product. So let me move on to capital efficiency across the group. I think when we announced the merger, so go back before we closed the merger, and through when we closed the merger, there was a perception that we had migrated from asset light, capital light to balance sheet heavy, capital intensive. And so I do think that in all the conversations we've had since then, in the almost, a couple of years since then, I think that perception has become increasingly accepted as not true. But I think this is a good example of why that's the case. If you recall back to our Investor Day, at the time we suggested we'd have $15 billion of investment capacity in the holding company, in the group, over 5 years. And we said, think of that as 3 buckets of $5 billion. $5 billion to pay the base dividend, $5 billion to increase the dividend and do share buybacks and other. And then the last $5 billion was for strategic growth investments. And so if we look at what we've actually spent today of that last $5 billion, we've spent about $500 million. So we really haven't had the need or, frankly, the opportunity to spend that capital. Most of the growth we're conducting and focused on across the firm doesn't require capital, doesn't require holdco capital. And so I think that illustrates the point of balance sheet light post-merger. I think it's also illustrated by this simple example, which I think you probably understand well. If you take any platform, the equity capital is provided by the alternatives portfolio, now AAA, now partly third parties, and that platform creates product, and then the product is allocated back to Apollo and goes down these different chutes that we've been talking about, creating a combination of FRE and SRE. But really importantly, is not requiring any holdco capital. So Chris touched on this before. It is actually, I think, a really important point that we've spent $8 billion over a decade to build this business. And so that's really hard to replicate. That's been done with de minimis holdco capital over that period of time. What is common is that we'll bring in equity partners into the platforms over time. And you can see here, co-investors, that co-invest column is where we've brought in a partner to take a piece of the equity in the business. And so why do we do that? For a couple of reasons. It's further alignment. It's alignment in a couple of ways, actually. AAA as an entity is aligning between Athene and third parties who are buying into the AAA investment business. And then under AAA, the platforms sit, and the platforms also have equity provided both by AAA and by co-investors, by partners who bring in capital. And so that's important because I think it helps diversify risk and avoid undue concentration. To us, it helps with recycling capital as well, so that we can keep growing the business. I think importantly, and I'll just touch on this quickly, AAA as a source of capital has benefits far above and beyond the platforms. You can see here, and I've put the Athene balance sheet back together again here to show it grows because this represents the true sort of combined alternatives portfolio. We have about $14 billion today sitting in the alternatives portfolio. That $14 billion has been allocated in 3 principal areas. One is everything we're talking about today, which is that first dark green shaded box, the 16 platforms and buying the equity there. But it also provides capacity to seed funds. And so if we look at the newer businesses that we're focused on, clean transition, infra, secondaries, they are partly funded by seed capital from AAA. And then lastly, that capital allows us to invest in other strategic retirement services platforms. So think Athora, Challenger, Venerable, FWD. And we haven't modeled the financial impact or benefits of those last 2, but they are further FRE benefits and their further strategic benefits to the overall platform. So this gets to the point about evolution of platforms. Again, it's not formulaic, but it's typical for us to make an initial investment and own 100% of a platform, and then we will scale it, and then over time, we will diversify ownership, and we'll bring in third-party capital for the same reasons, and that is sort of we don't want to own 100% of anything in particular. We want value diversification, risk management, and capital recycling. And so that's a typical model for our platform ownership. So let me move to the last topic, which is the capital solutions business, and just provide a bit more focus on this because it's been very important to us. Again, we believe we have a differentiated model relative to our peer set in this business. And so we combine origination capabilities, capital markets capabilities, and syndication capabilities. Origination is partly everything we talked about today, and it's partly originating across the entire Apollo ecosystem. It's pieces of equity from our equity business that are syndicated. It's pieces of hybrid. It's pieces of other credit business, all of which comes into this business. We have a capital markets team. We have a capability that we've assembled over the last really handful of years of people who have spent their whole careers on Wall Street in capital markets businesses, debt capital, equity capital, hybrid capital, convert capital. They bring decades, individually, they bring decades of experience in structuring and distributing transactions. And so they sit with our teams and structure transactions for our clients. And then we've sort of partially built, partially still building a syndication team that can cover buyers of paper. And so that's obviously important to have that last piece in place. And so you really need all three to make this business successful. Interestingly, so year to date, 9 months through September 30, we've closed 160 transactions in our capital solutions business. It's exactly 50-50 split between platforms. The majority of that is Atlas, but it's others as well. And then the other 50% is everything else. It's corporate origination, investment grade, non-investment grade. It's sponsor origination. It's equity co-invest, hybrid value co-invest. And so it's a piece of our whole ecosystem that's coming through this business. If we then look at the fees that we've earned as a good representation of what the business looks like now, this is the 9 months again. We've generated for the 9 months $420 million of fees. I think, again, you look at the mix of fees that are created by either debt or equity, and it's about an 80-20 split at the top of the page. Of that 80% debt piece, about 2/3 of investment grade and 1/3 is below investment grade. So again, an orientation to investment grade credit down the page. The balance of that is portfolio company refinancings. And then the last piece is equity fees, and that comprises fees from syndicating equity across each of our equity businesses. Another important point I'd make here is that only a small amount of these fees actually require capital support. And that's so 10 to 20% of the fees are supported by balance sheet capital. That's supported by an arrangement with a partner we have that helps provide balance sheet. But that's important that most of the transactions we do here are fully syndicated at the time of commitment. So I'll wrap. I think hopefully these are the objectives of the day. So hopefully this has become clear that this is hopefully what you walk away with today. We are really pleased and proud of the business we've built. We do think we have a distinct business. We do think that there's a reliability to the production across all of the businesses, including the platforms that we have. And that's all about creating proprietary credit assets. Most of that is investment grade. As you've seen from the decade, the $8 billion of capital, the mistakes we've made, the lessons we've learned, it is a competitive advantage. It's hard to replicate this business. We are focused on investment grade. We are focused on minimizing credit risks and credit losses across the portfolio. You've seen how we do that in 3 examples today. I do think we are highly capital efficient. The platforms are a good example of that. But I think spending $500 million of the $5 billion in 2 years is probably a better example of that. And then all of this translates into earnings power, multiple forms of fee-related earnings, and then multiple forms of spread earnings. At the same time, making sure we have capital, a supply of investment-grade credit to allocate to our capital partners. So I will stop there. I'll invite Noah actually up to the stage. We'll take a minute break to get some chairs up, and then we'll take some Q&A.